In the world of finance, there's a common misconception that investing is a game best left to the experts. We imagine Wall Street tycoons in tailored suits, huddled around blinking screens, making split-second decisions that rake in millions. But what if I told you that you too could unlock the secrets of successful investing? What if you could learn to navigate the stock market and grow your wealth, even without a finance degree or a team of analysts? The truth is, smart investing is within everyone's reach, and it all starts with understanding the power of informed decision-making. Imagine a world where your money works as hard for you as you work for it. That's the promise of smart investing. It's about partnering with companies you believe in, becoming a shareholder in their success, and watching your investments grow over time. It's about taking control of your financial future and building a solid foundation for yourself and your loved ones. But how do you get started? How do you separate the winning stocks from the duds? How do you make informed decisions in a market that can feel like a roller coaster? The answer, my friends, lies in the wisdom of those who've mastered the art of investing. Individuals who've spent years studying the markets, identifying winning strategies, and achieving remarkable returns. One such individual is Peter Lynch, a legendary investor who managed Fidelity's Magellan fund and achieved near-mythical success during his tenure. Peter Lynch is synonymous with investment success. As manager of Fidelity's Magellan fund, he achieved an average annual return of 29.2%, more than double the S&P 500's performance. His insights inspire countless individuals to explore investing. Lynch believes anyone can be a successful investor. He champions the individual investor, observing, listening, and trusting instincts. His approach is grounded in common sense and practicality. His book, One Up on Wall Street, empowers individual investors. Lynch demystifies investing and breaks down complex concepts, encouraging investors to use what they know. Spot winning companies by paying attention to the world around you. In investing, there's a David versus Goliath narrative. On one side, institutional investors with vast resources and analysts. On the other, individual investors with unique perspectives. Peter Lynch reminds us that individuals have distinct advantages. One key advantage is agility. Individuals can make quick decisions, unlike large institutions. They can invest in smaller, lesser-known companies. This nimbleness gives them an edge. Another advantage is personal experience. We interact with businesses daily, observing firsthand how companies perform. Trust your instincts. If a company is innovating and expanding, it might be a good investment. Don't be afraid to bet on companies you believe in. Leverage your strengths to unlock remarkable returns. One of Peter Lynch's enduring principles is simple. Use what you know. Trust your observations and recognize investment clues in plain sight. Pay attention to the world around you. We interact with businesses daily. We shop, use products, visit websites, and share experiences with friends and family. These interactions are a goldmine of investment insights. Notice bustling stores and enthusiastic employees. Dig deeper to see if the company is publicly traded. From shopping carts to stock portfolios, turning everyday insights into profitable investments. Lynch's use what you know philosophy empowers us to become active participants in our investment decisions. It invites us to become amateur detectives, to observe, analyze, and draw our own conclusions. Notice trends like a popular toy brand your kids love, or a new fitness tracker gaining popularity at your gym. Trust your instincts, follow your curiosity, and investigate further. You might just uncover a hidden gem poised for success. Beyond the hype, trusting your gut and your own due diligence. While Lynch encourages us to trust our instincts and to draw upon our own experiences, he's also quick to emphasize the importance of conducting thorough research before making any investment decisions. Use what you know isn't about blindly investing in companies you happen to like or products you use regularly. It's about leveraging your observations as a starting point for further investigation, a catalyst for digging deeper and understanding the underlying fundamentals of a business. Remember, even the most promising companies can face challenges, experience setbacks, or fall victim to changing market conditions. That's why it's crucial to go beyond the hype, to look beyond the surface appeal of a product or service, and to evaluate a company's financial health, its competitive landscape, and its long-term growth prospects. Start by examining the company's earnings growth. Is the company consistently increasing its profits year over year? Are its revenues growing at a healthy pace? These are key indicators of a company's financial well-being and its ability to generate shareholder value. Next, delve into the company's management team. Are they experienced, reputable, and aligned with the interests of shareholders? A strong management team is crucial for navigating challenges, making strategic decisions, and driving long-term growth. Don't overlook the importance of understanding the company's competitive landscape. Who are their main competitors? How do their products or services compare? Is the industry as a whole growing, or is it facing headwinds? Understanding the competitive dynamics of an industry can provide valuable insights into a company's long-term prospects. Finally, consider the company's debt levels. Does the company have a manageable amount of debt? Is its debt load increasing or decreasing? High levels of debt can be a red flag, signaling potential financial instability and limiting the company's ability to invest in future growth. Navigating the stock market landscape. Understanding Lynch's 6 stock categories. Imagine walking into a vast supermarket, aisles overflowing with products. The stock market can feel similarly daunting. Peter Lynch offers a roadmap, categorizing stocks into 6 groups: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Understanding these categories is crucial for informed investment decisions. Some companies grow slowly, offering stability, while others skyrocket, promising rapid growth but higher risks. Lynch's system helps us evaluate companies and align investments with our goals. It's about recognizing that a one-size-fits-all approach to investing doesn't work. So, grab your shopping cart and let's explore Lynch's stock market supermarket together. From steady growers to hidden gems, deciphering the characteristics of each stock type. Let's start with slow growers, the tortoises of the stock market. These are large, well-established companies growing slower than the overall economy, like utility companies or consumer staples giants. They offer stability and often pay dividends, appealing to conservative investors. Next, we have the stalwarts, reliable workhorses growing at a moderate pace, around 10 to 12% per year. Think of blue-chip companies like Coca-Cola or Johnson & Johnson. They balance growth and stability, suitable for investors seeking both capital appreciation and dividend income. Now let's turn to fast growers, the racehorses of the stock market, expanding at rates exceeding 20% per year. These smaller, agile companies in industries like technology or healthcare offer substantial returns, but come with higher volatility. Moving on, we encounter cyclicals whose fortunes are tied to the economic cycle. Industries like automotive and airlines thrive during economic expansions but struggle during downturns. Timing is crucial with cyclicals, requiring careful monitoring of economic indicators. Tailoring your investment strategy, aligning stock categories with your risk tolerance and financial goals. Now that we've met slow growers, stalwarts, fast growers, and cyclicals, let's move on to turnarounds and asset plays. Turnarounds are companies showing signs of recovery after hard times, requiring careful due diligence and a willingness to stomach potential volatility. Asset plays possess valuable, often overlooked assets like real estate or patents. Identifying these companies requires a keen eye for value and patience for market recognition. Understanding these 6 stock categories is like having a secret decoder ring for the stock market. The ideal category for you depends on your risk tolerance, investment timeline, and financial goals. Are you seeking steady income? Slow growers or stalwarts might be a good fit. Comfortable with higher risk? Fast growers or turnarounds might interest you. Value-oriented? Asset plays might be up your alley. Unveiling a company's true value. Before buying shares in a promising company, thorough vetting is essential. Think of it like inspecting a house before purchase. Investing in a company's stock is no different. You need to know it's on solid ground. Peter Lynch emphasizes rolling up your sleeves and digging into the company's financials. It's about separating hype from reality and making informed decisions based on facts. Think of yourself as a financial detective, uncovering clues about the company's financial health and growth potential. Start by familiarizing yourself with key financial metrics like earnings growth and the price-to-earnings ratio. These are the vital signs of a company's financial well-being. Once you understand these metrics, you'll be well on your way to making informed investment decisions. Earnings growth, P/E ratio, and balance sheet health. Let's start with a company's earnings growth, a crucial indicator of profitability. Look for a consistent track record of earnings growth, ideally outpacing the overall market. Next is the price-to-earnings ratio, PE ratio, telling you how much investors are willing to pay for each dollar of earnings. Compare a company's PE ratio to its industry peers to see if it's trading at a premium or discount. Now let's move on to the balance sheet, providing a snapshot of assets, liabilities, and shareholders' equity. Examine the company's debt levels. Too much debt can signal financial instability. Look at the debt-to-equity ratio, measuring the proportion of debt used to finance assets. Another important factor is cash flow, indicating the inflow and outflow of cash. Positive cash flow is essential for meeting financial obligations and investing in growth. Look at the company's operating cash flow, measuring cash generated from core business operations. Positive and growing operating cash flow is a positive sign of financial health. Understanding the company's products, services, and competitive edge. While analyzing financial statements is essential, understanding the qualitative aspects of a company's business is equally important. What products or services does the company offer? Are they in high demand? Does the company have a competitive edge? Start by understanding the company's core business model and revenue streams. Delve into the competitive landscape and identify the company's main competitors. Pay attention to the company's management team and their track record of innovation. Consider the company's social responsibility and environmental impact. By looking beyond the numbers, you can gain a comprehensive understanding of a company's overall health and long-term potential. Riding the waves, staying the course amidst market volatility. The stock market is like the ocean, vast, powerful, and prone to unpredictable swings. One day it's smooth sailing, the next a storm hits, sending waves of fear and uncertainty. Peter Lynch advises ignoring the noise, the daily barrage of headlines and market predictions. The stock market is driven by emotions as much as fundamentals. Instead of getting swept away by market emotions, focus on the underlying strength of your investments. Think of yourself as a ship captain, relying on your compass and knowledge to stay on course. Trust your research, weather the storms, and stay focused on your long-term investment horizon. Short-term market fluctuations are normal. Use them as opportunities to revisit your investment thesis. Let your rational mind and long-term vision guide your investment strategy. Why trying to predict the market is a fool's errand. The stock market is inherently unpredictable. Trying to time the market is a fool's errand. It's like trying to catch a falling knife. Peter Lynch dismisses market timing as a losing game. Even experts with sophisticated models get it wrong. They often end up with egg on their faces. If the pros can't predict the market, what chance do we have? Very little, according to Lynch. Focus on choosing great companies and let compounding work. Time is your greatest ally in investing. The longer you hold, the more they grow. Think of it like planting a tree. Plant it, nurture it, and let it grow. Investing is much the same. Choose companies with strong roots and let them grow your wealth. Don't get distracted by daily noise. Focus on the long game and let your investments flourish. Patience as your secret weapon for building wealth. In a world obsessed with instant gratification, Peter Lynch reminds us, building wealth takes time. It requires patience, discipline, and a willingness to stay the course. Successful investing is about partnering with great companies and letting them compound your returns over years. Think of it like a snowball rolling down a hill. Compounding works in much the same way. Reinvest your earnings to grow your wealth exponentially over time. Patience is not passive. Stay informed and monitor your portfolio. Remember, investing is a marathon, not a sprint. Embrace the power of patience and let your investments grow. How to identify undervalued and overlooked companies. Find hidden gems by observing consumer trends, tech advancements, and emerging industries. Venture beyond familiar names and Wall Street darlings. Focus on smaller companies with strong growth potential. Seek out-of-favor companies with temporary setbacks. Look for positive changes like new management or product launches. The art of contrarian thinking zigging, when others zag. Finding hidden gems often requires a contrarian mindset, a willingness to think differently than the crowd. It's about being comfortable going against the grain and seeing opportunity where others see risk. This doesn't mean blindly betting against the market. It's about thinking critically and questioning assumptions. Recognize that the market is not always efficient, creating opportunities for savvy investors. Tune out the noise and make decisions based on your own research. In moments of market exuberance, contrarian thinking is most valuable. Maintain a long-term perspective and focus on fundamentals. As Peter Lynch reminds us, the person who turns over the most rocks wins the game. Finding your investment compass. Simple principles for lasting success. We've journeyed through investing with Peter Lynch's philosophy of use, what you know, his stock categorization system, and emphasis on thorough research. Ignore market noise, embrace patience, and venture off the beaten path for hidden gems. No magic formula guarantees success. Successful investing doesn't require a PhD. Embrace simple principles to guide you. Navigate the market towards financial well-being. Focus on the strength of companies. Investing is a long game requiring patience and discipline. Embrace these principles for a secure financial future. The power of simplicity, cutting through the noise to focus on what matters. Peter Lynch's investment philosophy is refreshingly simple. In a world full of data and jargon, Lynch reminds us that simplicity is often most effective. Cut through the noise, focus on understanding the businesses you invest in. A company that grows earnings and generates strong cash flow is likely a good investment. Recognize companies with strong brands and loyal customers for long-term success. Focus on the basics. Understand how a business makes money. Investing is about aligning with great businesses, not predicting the market. Embracing the journey, becoming a student of the market and of yourself. Investing is not a destination, it's a journey. It's a journey of discovery, learning, and evolving your understanding of the market and yourself. The best investors are lifelong students, eager to learn and adapt. Embrace this journey with curiosity. Read books, attend seminars, follow industry news, and never stop asking questions. The more you learn, the more confident you'll become in making informed decisions. Remember, investing is about understanding yourself as much as the market. Define your investment goals, risk tolerance, and timeline. Be honest with yourself about your financial situation and objectives. Learn from mistakes, adjust your approach, and keep moving forward. Embrace the journey, learn from experiences, and never stop growing as an investor. With hard work and Peter Lynch's wisdom, you might just find yourself one up on Wall Street. Good luck and happy investing.